It's going? In the last video, we showed how a stock option portfolio, where the profit is in the black, compares to an options portfolio with this very large profit area. Today we're going to show how to create a portfolio that gives you this kind of a risk profile graph. I call it a conservative options portfolio because the stock can fall all the way from 107 down to 100 before you lose money. In fact, you gain money if the stock falls by $6 during the month or goes up by $6, anywhere within that range. Before we move to how we set up this option portfolio, let us explain why we can make money when the stock doesn't go up at all. Almost every asset depreciates over time, except maybe gold and land, because they're not making a lot of it. But everything else, if you buy something, an asset, it's going to go down in value over time. If you buy a car, you drive it out of the dealer's lot, and you've lost 20% of its value. Options, like cars, don't depreciate in a very steady line. But just the opposite of cars, options decline very, very slowly at the beginning and very quickly at the end. If you think that a car depreciates fast, you ought to own an option. Many options depreciate to zero in a single month. Other options depreciate to zero in a year. In the options business, we don't call it depreciation, however. We call it decay. In fact, they've given it a Greek term. It's called theta. I think there's a conspiracy out there to confuse people about options trading. So they give everything a Greek name, so it's Greek to everybody. This is an example of the depreciation or the decay of an option that lasts for 1 year. You can buy a call option on the stock SPY while the stock is selling for $106 a share. And you can buy the right from somebody else to buy that stock for $106 a share for 1 year, and you pay $12.80, or actually $1,280 for that option. If the stock doesn't change in value over the next year, every single month that option is going to become worth less. After 30 days, it will have depreciated from $12.80 to $12.20. It will have gone down in value by $60. However, at the very end of the option period, after 12 months of getting worth less each month, it depreciates in the last month by $330. That's sort of like what happens when you drive your car out of the dealer's lot. It depreciates or decays by $60 in the first month. It decays by $330 in the final month. In option terms, they say theta is about $2. Theta is how much it depreciates in 1 day. About $2 per day in the first month and over $10 per day in the last month. We make money in the options business very simply by buying an option that's got 12 months of remaining life and using that as collateral to sell somebody else this option over here that is going down in value very quickly. When we do that, we are putting on what is called a calendar spread. They also call them time spreads. You buy an option that has a longer period of life than the option that you're selling. And as long as it's at the same strike price, in this case we're talking about a strike price of $106, you don't have to come up with any more money. You collect the money from selling the option and you deduct that from what you pay for the option. In this case, we buy an option for $1,280 and at the same time we sell to somebody else an option that has only 1 month of remaining life for $330. We only have to come up with $950, or the difference. Now, we have sold an option that's going to depreciate by $330 if the stock stays the same, and we own one that's going to depreciate by $60 in 1 month. So that means that we essentially gain $270 of value on an investment that costs us $950. in 1 month. That's assumed the price of the stock stays the same. So let's look at what this looks like on the graph. Okay, I got another thing.
Okay.
This is the risk profile graph of the $950 we spent to buy an option that had 1 year of life and sell another option that had just 1 month of life. It was at $106 a share, so that if the stock doesn't change at all, we're going to make about $270. That's the difference between the one this option we own goes down in value by $60. The one that we sold to somebody else goes down in value by $330. So we gained $270, which is just about here. However, we know that stocks don't stay the same all the time. In this case, if the stock falls, we make less than if it stayed the same. Or if it goes up, we make less than if it stayed the same. On a break-even standpoint, if the stock falls from 106 down to about 100, we start losing money on the downside, and the same on the upside. If it goes up by more than $6, we start losing money. So we're betting that the stock will stay relatively steady. Most months, SPY, S&P 500, fluctuates by less than 6% in a month, so that we would be in a profits position with this one option. However, once we get beyond a $6 or 6% price increase or price decrease, we fall below the zero line here, we start losing money. So in order to have a conservative option strategy, we wouldn't buy just one of these calendar spreads. We would buy several of them. We'd buy some at different strike prices, some below the stock price and some above the stock price. The net effect of having several calendar spreads in place at one time is that you lower the maximum profit for the entire portfolio, but you broaden the break-even range so you can make money when the stock fluctuates more than just a small amount each month. This is more of a Mesa-shaped risk profile graph. It doesn't have a single point where you hope the stock is going to end exactly at that price. Pretty much you get the same return, in this case 12% in a single month, at any price between $102 and $113. That's quite a long range. Any place within an 11-point range, this portfolio in 1 month is going to make about 12% gain on your money. I created this risk profile graph by buying calendar spreads, buying an option that had a year of remaining life and selling an option at the same strike price that had only 1 month of remaining life at the 107 price, the 109 price, the 111 price, and also the 105 strike. 4 different calendar spreads at different strike prices created this risk profile graph. Now I want to explain, it's not very easy to create this graph on your own. But there's a young fellow down in Argentina who wrote a wonderful little software package, very inexpensive. He charges $38 for it. In fact, if you go to our website, terrystips.com, tip 8, you'll be able to buy this, and there's a code in there. If you put the code in there, he gives you $5 off because I've sent him so much business. It costs you $33 to buy this Excel graphic package, where you put your calendar spreads in there. It goes out and finds out what the current price of those options are and creates a graph like this. And if you'd like to change the graph so that you've got more protection on one side or the other, you just buy calendar spreads, additional calendar spreads, at the strike price in the direction that you think you need protection. If you think the stock is going to go down, you want to buy more calendar spreads down here at the lower levels and fewer up there. In the next video, we are going to talk about what happens when the stock moves so far that you're coming to this point where you start losing money if it continues to go any further in that direction. We call them making adjustments. Essentially what we're trying to do is to, if the stock's falling, for example, we want to shift the whole graph to the left. And next time we'll talk about exactly what you need to do to carry that out.